Hello, this is Joe Hoyle at the University of Richmond, and it is a beautiful day here today in Richmond, Virginia. I hope that wherever you're at today is half as pretty as it is outside here today. But we're in the studio to make sure that you can get the information that you need to help you to be successful in the financial accounting course that you're taking. In this chapter, we're talking about the conveyance of financial information, how financial information gets from a company to the decision makers who need to make use of it. In this particular lesson, your roommate has asked you about certain accounting terms. And I picked the terms out that I want my students to know at this point in the course. I will often put terms like this on the board, like I have them here, and I tell my students, if you understand these terms, then you've gone a long way toward understanding how financial accounting works. You can cover a lot of material by simply understanding the true meaning of these words. So what I want to do with you today is to walk us through these few terms just to make sure that you understand what they mean. Just like in the problem, your roommate wanted to know because her parents were using these terms with their business. The first term is financial statements. Financial statements is the way that information is conveyed. It's the formal structure. Every company that has stock that is sold must issue financial statements. And in fact, you can often go on the internet and find the financial statements. In my classes, I ask my students to find financial statements for companies like Merck or companies like IBM or companies like Google by going to their website and looking at the financial statements. It is the formal structure to convey information. And usually, as we will find out, those financial statements are made up of an income statement, a statement of retained earnings, which is often an expanded statement of stockholders' equity, a balance sheet, and a statement of cash flows. So we typically talk about four financial statements: income statement, statement of retained earnings, balance sheet, statement of cash flows, and in addition, to help explain that information, there are always notes that are attached to those financial statements. So if you go to the Google website, for example, and you look at their financial statements, you'll find an income statement, statement of retained earnings or stockholders' equity, balance sheet, statement of cash flows, and you'll find the notes to the financial statements. The second term is inventory. It's a simple term. Inventory is anything a company buys or makes to sell. So if you go to a grocery store, the apricots, the canned hams, those are all inventory because the grocery store buys them to sell to their customers. If you go to an ice cream store, the ice cream is the inventory. It's bought or made to sell to customers. Assets, now that's a tremendously important term in accounting. An asset is anything that has probable future value. It will help you make profits in the future. A building, for example, is an asset because it will help you make profits in the future. Inventory is an asset. Equipment is an asset. Cash is an asset because all of those things have a future value to them. In my classes, when a student says, "Is this an asset?" my answer is very simple. Will it give you a future value? Will it help you to generate profits in the future? If the answer is yes, yes, it is an asset. A liability is a probable future sacrifice. Now, typically, we don't use that kind of a formal statement. It's easier just to say that a liability is a debt. If you owe money because you borrowed it from a bank, that's a liability. If you owe money for the rent, that's a liability. If you owe money to your workers, that's a liability. A liability is any debt. Now clearly, whether it's assets or liabilities, that's information that helps you understand the financial health, future prospects of a company. So if you're looking at a company, should I buy the stock, for example? Then the question comes back, how many assets do they have? How many liabilities do they have? You're starting to pick up that information that you can gather about an organization. Revenue is the money that comes in from selling something. You sell inventory or you sell a service. The revenue measures what the inflow of the assets were from selling a good or a service. So for example, if you looked at PepsiCo, you could find out how much they get from selling soft drinks. That's a revenue because it's the money or the assets that came into the company from selling a good, in this case soft drink, or a service, a revenue. And if you're going to judge how well a company's doing, then clearly knowing their revenues is very helpful. Expenses is kind of the opposite. It is the outflow of money, it is the outflow of assets in hopes of generating a revenue. It has a past benefit. So if you paid money for rent for 3 months ago, that's an expense. Why is it an expense? Because it was a decrease in your assets, you paid it. And you paid it in hopes of using that facility to generate revenues or profits. In a business, there's lots of expenses. You have rent expense, you have salary expense, you have utilities expense, you have repair expense. All of those things are expenses because they have a past value. They were used in the past to help you generate revenues or profits. If it has a future value, it's an asset. If it has a past value, it's an expense. Contributed capital is the amount of money or the amount of assets that your owners have put into the business. You have ways of growing. You can grow from selling things, but you can also grow because your owners put money into the business. So for example, if you and your roommate were going to start a business and you put in $800 and your roommate put in $500, then the business would have $1,300. The contributed capital would be that $1,300, the amount of the money that was put in by the owners. So as an example, if you looked at the financial statements for a company like DuPont and you found the contributed capital figure, it would tell you since the first day that DuPont began decades ago, how much money, how many assets the owners of that company have put into that business. That's more interesting information. Gross profit's a number I like. Gross profit is the difference in what you buy inventory for and what you sell it for. You may have heard the term markup. Gross profit is the markup. So for example, let's assume that I work in an ice cream store and I buy a gallon of ice cream for $1 and I sell it to you for $3. Then my gross profit, the difference in what I bought it for and what I was able to sell it for, is $2. And that is the gross profit. So if you're looking at a company and you want to know how much they have marked up the cost of their inventory, you can determine that by gross profit. Recently I was going to buy a radio. So I looked in the financial statements for the company and I found out what their gross profit was. So when I went into the store, I had a fairly good idea of what the markup was on that radio to see if I thought they were making too much profit and had marked it up too high. Now in your course, in your financial accounting course, these terms are extremely important. They will help you to understand the information that a business is conveying about what they do, whether it's the financial statements, inventory, assets, liabilities, revenues, contributed capital, expenses, gross profit. These are terms that virtually everyone in the business world knows. This is not mysterious stuff. Everyone out in the business world knows this. If you're going to be successful, you need to know them too. And they're not terribly hard. An asset has future value, an expense has past value. That's easy, but you do need to know these. Again, it's a beautiful day in Richmond, Virginia today. Hope it's just as pretty wherever you are. Study hard, go out and enjoy the weather. Have a great day.